Good morning, everybody, and welcome to the Hardcore Mortgage Podcast today for Wednesday, June 23rd, 2021. It is a lovely day out there, and with me, and we're going to get everybody, I'm going to warn everybody straight up, we're going to get real mortgage nerdy, we're going to get real mortgage geeky. It's what we do for a living every day, eat, sleep, and drink it for the last 32 plus years. We're going to break it down really hard today, and with me, we have John Kolb and Harvey Freed. Good morning, gentlemen.
Good morning.
Hey.
Yeah, Becky's probably going to join us a little bit later. Lisa couldn't be on the podcast today, but I know Becky's going to want to join us. So, gentlemen, we're going to dive right in. A lot of articles, a lot of movement, a lot of volatility in the market. As we discussed last week, we're going to get into mortgage rates. We're going to get into lumber prices. We're going to get into a huge article in the Housing Wire magazine regarding the Federal Housing Finance Agency director and what this one guy is doing to mortgage rates in the mortgage industry and mortgage programs all across the United States. People, I'm telling you, we're going to get deep. We're going to get real geeky on this. But first of all, gentlemen, I'm going to start with you, Mr. Freed. Usually I start with Mr. Kolb, but I'm going to start with you, Mr. Freed, today. Guess what, Harvey? As previously discussed, mortgage applications are rising, on the rise again. Summer's kicked in. Probably summer sales and refinance action. Harvey, what do you have to say about that?
Yeah, prices are still up here. Of course, due to the lack of inventory, we're seeing a rise in prices. It is the fourth straight month where the sales figures are actually down from last year due to the fact, again, the prices are not down, but there's just a little bit of lack of inventory, many families fighting over the same homes. And we'll see how it's going to change throughout the year. We don't see any significant changes. You can't snap a finger and build brand new subdivisions. It takes a lot of time. And like you said, later in this conversation, we'll talk about some of the delays in the new construction world.
Yeah, John Kolb, again, mortgage applications are rising again, up 2.1% in purchases and up 3% last week. We're going week over week. Again, summer sales action, and people might be taking notice. John Kolb, people might be saying, why am I waiting to refinance?
Yeah, I mean, there's still so many good opportunities to do so many different things. Pay off some credit card debt, do a home improvement, all with very good interest rates that are going to be, equal to better than what you're expecting. So, I mean, our purchases, we're starting to see them come through, not as much in appraisal guarantees, not as much in, occupancy, and it's coming back to a little bit of normalcy, but the prices are still up there, which I'm excited to see. I like to see people selling their homes, making a good deal of money, being able to apply it to a new home and upgrading without much change in their monthly nut. So it's exciting. It's a good time to be doing this. We're getting into the summer months, and hopefully everyone's going to enjoy it. Enjoy the ride.
Yeah. I'm also experiencing in certain areas that are extremely, we call it hot. I mean, that's a mortgage term. The market's hot, right? There are a lot of places where the market is hot right now. And you're seeing that irrational exuberance still, the appraisal guarantees, people going in, offering $25,000 over, but the house is selling for $50,000 over. Harvey Freed, the appraisal guarantee, it seems to be the standard right now with every single offer. And I don't think they're going away anytime soon. What do you think?
Well, Harry, I'll tell you, there's a lot of emotions that go along, as we know, into a purchase. And now families are being told from their real estate agents that in order to get this offer accepted, they have to put this kind of language in there. They have to overbid $10,000, $15,000, $20,000, and then write into the purchase agreement that they're accepting the fact that they might have to come out of pocket for that extra money, that extra 10 or 20,000. It is the norm, Harry. We don't see anything changing. Again, the inventory shortage is going to cause this over the next probably year or two, and I don't see any change on the horizon.
Yeah, that information that Harvey threw out, John, and I like that. I think it's going to make for a more well-rounded, more informed buyer. And what I mean by that is that if it's normal to go in with all these contingencies, and it's normal, and I use air quotes, normal, that all these things have to be put into play, that means we as mortgage bankers are going to put out a more educated consumer / buyer in the market. So it won't be a weird thing. It won't be something out of the blue that we're discussing with our buyer, right, John?
Well, I think the emphasis is on we being capital mortgage funding. The other lenders out there aren't informing anybody on anything. They're going in willy-nilly, don't understand what a $40,000 appraisal guarantee means, and the buyers are getting caught off guard once their offers get accepted. You know, I rely heavily on my real estate partners, but at the same point, I make sure that I understand the numbers and explain it to the client as well, because I want to come in from all angles. But you got some really yahoos out there that are not explaining anything. They're just doing what they think is the norm without understanding and explaining the implications to the client. So yeah, we're, you know, like you said, Harry, our clients are going to be more knowledgeable. That's why people should work with us. And other than that, you know, if you go with somebody else that is kind of off the wall, not as accessible as 9:30 on a Sunday like Harry Glanz is, then you know what? Good luck to you, and we'll see you when you guys need help.
Well, I appreciate that, and you bring out a good point. And Harvey, let me go to you in a second, but you bring out a good point. Yeah. I mean, we're in the streets, okay? Becky, Lisa, Harvey, John, myself. We're in the streets, and we're you know, when I say this, I mean we're in it, okay? We are in it every single day, and John, there are a lot of lenders that just pick up a phone, they look at a computer screen, they don't know what's going on in the street. We're in the street with our buyers and our real estate partners, our builder partners, and we go through the same experiences day in and day out, 10, 15 times a day as our buyers are going through. So Harvey, you know, we have to talk about service levels and expectations. We have to talk about accessibility. We have to talk about 24/7, 365. But what I'm really talking about, Harvey, there are just people out there that are still flying blind and by the seat of their pants, and they're not getting the accurate information. And I know nothing bothers you more than that.
John Kolb said it. He called them. There's some agents out there that are willy-nilly. They're new to the industry. They haven't been around. They don't have the experience. These are all real things that we're experiencing on the buy side, including here you saw I turned around and had to grab this file, turned in a brand new purchase down in Florida. I love that the client, I've been applauding him because he's calling me more and more now. He doesn't have a qualified real estate agent. Now the house is in a flood zone. He's got cold feet about moving forward. And we spent 2 hours on working up the file. I called his agent yesterday and haven't received a phone call back. It's over 24 hours. He's getting the same bad service, but being told he needs a $10,000 appraisal guarantee. It's bad out there for some of the families are not getting the service they need on the real estate end. We're finding out about it because the clients are calling us, and we immediately know if they're not up to the task, if they don't really understand what they just signed. And we think it's extremely important, going back to what we feel is important, is to build that strong team. Have a qualified real estate agent who's been around for 5 or 10 years, not someone who's been in Fantasy Island, Harry. If you show up, if Tattoo says the plane, and you land on the island and you're buying a house and you're working with an agent who just got his real estate license in the last 3 years, they don't know what to say. I know that because we have
I got a public service announcement. Even though Harvey Freed had that thick old file that he showed everyone, we are a paperless secure network company. That is just old school Harvey. He's got props. Our files are in secure. We are paperless. Thank you for the props, Harvey.
Well, we're joined today by Becky Alley. We're being joined right now by Becky Alley. Becky Alley is here. Good morning, Becky. How are you?
Hey, good morning, everyone. I like stepped in right at the perfect time.
Yeah, it's a hot topic. The hot topic is education. And I believe that hopefully with all of these appraisal contingencies, these overbidding, I think it's going to produce a more educated buyer. John and Harvey said that, well, they hope it does, but I've got one right now for you. Now, whose responsibility is this? And I'm going to put the responsibility on this example on the realtor. So right now we have a 3-unit property transaction right now. It's a purchase. Now we all know a 3-unit is not the norm. They're either a 2-family or a 4-family, right? Which we can do up to 4-family on one transaction. This is a 3-family, and it's in a mixed zone, a mixed use zone. Now, why wouldn't the realtor, Harvey, right? Why wouldn't the realtor tell somebody, well, you know, they might have a problem getting residential financing. This might be a commercial financing deal, unless you can get some kind of variance. And I told everybody we're getting geeky today. We're going to use words that most people don't hear. They're going to need a variance from the city to show that it can be rebuilt as the same property that they want to get a mortgage on, or else you have to do a commercial mortgage. In the residential mortgage and real estate world, if we go ahead and secure a property with a residential mortgage and something happens to that property, Becky Alley, it has to be rebuilt the same way as the mortgage has been secured, right?
Correct. Yes.
So why wouldn't the realtor, now it's coming down, of course, to the 11th hour, and our underwriter says, works for us, directly with us, our staff of underwriters, says we need to get a variance to show that it can be rebuilt the way that we're putting a mortgage on it. Why is that a shock, Becky Alley, to people? Why is it?
I don't know. I mean, it's just like there's a bunch of fad diets out there, right? They're like, I lost 50 pounds doing XYZ. Here's the Bible to do that, right? But then people don't follow that, right? So you can literally lead everyone to the fountain of youth and the fountain of how to get your mortgage transaction closed. But unfortunately, people don't hear it because you got to put some work up front. And even those warning sirens you're probably like sounding off in the beginning, they're not hearing it now until the 11th hour. Obviously, when you're doing a mixed use property, right, you have to show that it's more residential if you're going to live in it. We're not a commercial lender, right? So if someone is buying a house, they want to run a business in, or at some point in time, the person that you bought the house from had a business in there. So they had to do certain things to allow themselves to run a business. That doesn't mean that we can't lend on that, but there are very specific things like Harry is talking about that we have to do in order to lend on that property, because we are not a commercial lender.
Right. Let's get into new construction right now for a second. Let's talk about lumber prices. Last week on our podcast, last week on our radio show, the show heard every Saturday morning, 97.1 FM. Harvey Freed is the host. We're going into our 22nd year of doing that every Saturday morning from 9 to 10 on 97.1. We talked about lumber prices. Lumber prices are extremely expensive. They're historically expensive. But right now, it just seemed in the last week that we're talking about it, lumber prices are coming down a little bit. So my question to you, and I'll start out with you, Becky, and then go to John, then back to Harvey, because I want to give Becky a shot because she just joined us. It goes something like this for me. Okay, so lumber prices are coming down. Is this going to be an ongoing thing? And how long will it take, do we think, it hits the street in terms of the consumer going up to the builder's model? And are the builder going to, is a builder going to lower their prices in accordance with lumber coming down? What do we think?
No, I don't think
exactly,
so.
John, but I want to hear from Becky.
No, the answer is no. They are not. I mean, it's already hit. They already can see what they can get away with. There's more of a profit margin if the price is X, but now lumber is now a little bit lower. That's more of a margin that they're gonna keep, right? So, I did have we talked about it a couple of weeks ago on our podcast, right? I had a situation. New construction. We had the appraisal done the 11th hour. The builder was like, hey, everybody, I'm going to shoot you with a $15,000 price increase. And you're not going to do anything about it because the lumber has went up, right? Okay. So we were able to get around all those things, but the builder did agree to drop the sales price a little bit to offset the appraised value. So we did work that out. I mean, but yes, the answer to your question is no, they are not going to reduce the sales prices, because now that's more profit for them. Thank you.
There you go. John Kolb. That was a big hell no.
Hell no. Are they going to adjust their prices? Hell no. They, like Becky said, they're going to keep it in their back pocket in the event that they need to adjust and go from there. I will tell you, in driving up north almost every weekend, they are scavenging, looting every piece of wood that they can along I-75 on the back roads, looking for lumber to produce. So I think it's going to be very much like the toilet paper saga that we have going on right now. You know, the toilet paper companies are now not selling toilet paper because everybody was running to stock up, realized they didn't really need to poop that much. And now everybody's got more of an abundance of toilet paper than they need. So toilet paper isn't being bought right now. So the toilet paper company sales are down. Same thing with the lumber. Everyone's running to log right now. And they're going to have all this extra material that they're not going to be able to get rid of. And the prices are going to come way down to get rid of it. So that's my two take on both pooping and logging.
Well, hey, John, I think that some people would say that that's synonymous, don't you think?
Oh, boy.
There you go. You started it, and we try to keep this a highbrow show. And Harvey Freed. So
Yes.
Basically in this article about lumber prices, they're talking about, and there's a quote in here, it says that it'll probably be a while. Becky and John said the big hell no. It'll probably be a while before prices drop at Home Depot or Lowe's. And even then, few expect even wholesale prices to return to pre-pandemic levels. So there you go. So our panel is correct. We know that when people want to take a profit, what are they going to, all of a sudden they're going to say they don't want to take a profit anymore? I mean, come on, Harvey Freed.
Yeah.
All right, let's get geeky now.
Here.
I want to dive into something that's really, really geeky right now. We're going to talk about the Federal Housing Finance Agency. It's called the FHFA, not to be confused with Fannie Mae and Freddie Mac. The FHFA is the agency that oversees kind of Fannie Mae and Freddie Mac. And there is a director there. His name is Mark Calabria. He is the director of this. He's the head honcho. He is the guy that is single-handedly a year ago imposed a 50 basis points refinance tax to people that were going to lower their rate and save money. So basically what he said to all lenders is that, look, here's what we're going to do. We're going to charge the agencies, we're going to make the agencies charge another 50 basis points on loans on refinance transactions. So that hit all of our borrowers. Every borrower across the United States paid a 50 basis point fee. Okay, that's number one. Number two, he is the one that's telling the agencies now that on certain products like second homes and investment homes, we all know that during the pandemic, Harvey Freed, that people went out and bought in record numbers second homes and maybe investment properties because rates were so low. He's saying that he wants the agencies to curtail buying second homes. So he's going to raise the rates on this. And he's also going to limit the amount that Fannie Mae and Freddie Mac can buy. So you've got one guy, one person, Harvey Freed, controlling what is going on in the independent mortgage banking market. Just let's get geeky on this. Look, we do a lot of second homes in Michigan because Michigan is a huge second home state, Harvey.
Well, we do a lot of second homes across the United States, whether it be in Florida or up north in Michigan, Arizona, California. People are Colorado. People are buying them all over the United States. Of course, North and South Carolina, they're in the mix also. So, yeah, Fannie and Freddie have their belly full of second homes. The last 2 years have caused many families to go out and purchase those second homes. They're using them for not only their own leisure, but they're also doing the Airbnb thing and renting them out on their free time when they're not using these units. But yeah, Fannie and Freddie reached out and said, our belly's full due to the people walk away from their second homes when things get bad a lot faster than they walk away from their primary residence. And they're only able, I think the amount Gary was is 15 to 20% of the Fannie Freddie pool will be second homes or vacation homes, which again, now they're going to increase those interest rates, the cost of it, and that'll slow down a little bit of the lending on that side. But we should see the private sector pick up a little bit and maybe fill in the gaps there for that whole industry as we see more and more families wanting a piece of a vacation home that they can also maybe make money on in the future.
Yeah. So Harvey, that the intellect of that comment was superior because that is the reason. I said we're going to get real geeky on that. That is the real reason why that they're going to limit the number of second homes, because the risk pool on the second home is a lot greater than a primary. And Harvey, I know the number that they want to get down to is 4%. 4% of the loans in the United States, second homes and vacation properties, second homes, and investment properties. So That is the number they want to get down to. I got to go to our second home guy, John Kolb. When you hear that, would you ever walk away from your second home?
No. I mean, here, and I'm knocking on some wood right now because, you you never know what may happen to somebody in their financial situation, with their job, with their family, whatever the case, their savings, whatever the case may be. So, if it came down to choosing between a second home and a primary residence, of course, it's always going to be the second home that you walk away for if that's the only choice that you have. But I think that what he's doing is asinine. I think that what he is doing is not well thought out. And in fact, the government is making another mistake, allowing just one person to make decisions like this. It should not be a one-person decision. It should be a committee decision and or a voting decision based upon what's going on out there. The American dream is to have your own home, have a vacation home, have time, places to spend with your family, and limiting that and not allowing that for second homes is only going to just increase the purchases of rentals and then also bring down the quality of the second home market out there. People aren't just going to take care of a rental as well as they will a second home. They're not going to shoot up north every weekend to work on it, when it needs some work to be done. They're going to just let it go to crap, and then you're going to have just a bunch of crappy homes all over the place on nice water that will just have to turn and redo again. So I think it's a bad decision. I think it's a poor decision. And you know what? I agree with the article saying that he must go.
Yeah, I mean, I agree with that. I agree with that 1,000%. Because you have to understand too, like, these are well-qualified mortgages. I mean, not everyone can just get a second home, right? You got to put more money down. Your credit criteria's got to fit. I mean, it's not like you can everyone's getting second homes out there. And a lot of it has to do with the fact that if quarantine ever happened, right, people are going to want to turn around and they wanted to quarantine where they want to be, where they want to live, right? And the situation is 4% is a really low number, in my opinion. I think I don't know. I agree with, John, Harvey, obviously, but you have to have the credit score. You have to put more money down, and, people aren't looking to buy second homes just to be like, okay, I'm done with you now. Like John said. So.
Yeah. John referenced the article that was sent around. It was published by Housing Wire this morning at 10:25 a.m. by one of a guy that we collaborate with all the time by the name of David Stevens. And I talk to David on a weekly basis. I'm on calls with him, had the opportunity to go over some things with him at the last time that we can get face to face. And basically the paragraph is Mark Calabria, the director of the Federal Housing Finance Agency, must go. He is slowly but surely undermining the system he has been charged to oversee, imposing his own ideological will on Fannie Mae and Freddie Mac in a way that will leave them weaker, and the housing finance system that depends on them increasingly unable to meet the critical housing needs of the nation. If that is not an indemnification of what this guy is trying to do, okay, and I just cannot believe that that nobody has called for this guy's resignation. Let's just put it that way.
There's checks and balances, are there not? Like, how does one person just be like, okay, this is what I see, and that's just the end of it?
Yeah, but that's the whole thing. When you have people, Becky, in government positions, it takes a long time to go ahead and either get them out, root them out. Allegedly, right now, there's only one person that can get him out, and they're trying to get the president of the United States to have the power to get this guy out. That's how much power this guy has. So I said we were going to get geeky on this, and this really, now this is the second home market, right? This is the vacation and second home market as well as investment properties, trying to limit that, all right? The idea is to have qualified people buy properties that they're truly qualified for, and as Becky said directly, you have to go through more strenuous guidelines and qualifications in underwriting on a secondary residence than you do on a primary. So with that, I want to get to our last word, and we're going to go in reverse order. I will start with Becky. Last word of the day, Becky Alley.
Last word of the day is we got a lot of transactions going on. Don't let this news kind of deter you from a second home. If the rate is going up, we're going to weather the storm. We've been through these things before. It still makes sense. The dynasty that you're trying to build for yourself in a little bit of a higher rate should not deter you from, that dream of home ownership, second home. You're looking to invest. It doesn't matter what the interest rate is anyway. I mean, the rates are going to be what they are anyway. So we're here to help facilitate that. Obviously there's some things going behind the scenes that are beyond my pay grade to, remove this one entity, and hopefully it can be reversed, whatever he's trying to do. 4% I think is unrealistic anyway. So keep it locked here. Give us a call. The sooner you start the conversation, the faster we can get you into these homes.
Mr. John Kolb.
Hey, I'm just excited. Today marks the beginning of my family getting into town. We'll be up north. Much of the next 3 weeks to 2 months, and enjoying our second home. And you'll never find a happier client as one that finds a second home and closes on that, just knowing what the joy that they're going to have using that second home. So why taking that away from somebody is mind numbing, but good rates are great. Let's get it done. And we'll see you guys next week.
And Mr. Harvey Freed.
All right. My final thoughts here on this Wednesday are a couple of things. Yes, the second home does require a minimum of 10% down. Most families have 10, 20, 30, 40, and even more equity built in. They're not going to walk away from those as easy as most people think. They might even enjoy that house more. And because of the fact that they can work remotely, we did see an uptick in those second homes. Also, on the new construction side, are builders going to kick back money? No. Sorry, folks. The price of copper, PVC pipes, the plastics, the other materials that are into the house are just as hard to find, even though lumber is starting to plummet. The price of lumber is starting to plummet down. And then also getting labor out to build these homes has been a tremendous problem for builders over the last decade. And that's why the shortage of new construction homes are out there. When the housing debacle happened in 2007 and 8, many of the construction guys, rough carpenters and framers, they took off for other parts of the country. Welcome back to Michigan. When you get those guys back here to build your house, they're going to pay them a little extra, and that consumer is going to pay for that.
Yeah, thanks a lot, Harvey. Listen, my final words are rates are still very low. Whether you're purchasing a new home, refinancing your existing home, do it now. If you're going ahead and consolidating toxic debt, do it now. Rates are very, very good. The home market, the home purchase market right now, realtors are calling off the hook. Pre-approval letters are essential, and updated pre-approval letters are essential. You cannot go ahead and even entertain putting an offer in without a pre-approval letter. Also, the second home situation, we have money for second homes. We have money put aside for second homes. We have programs that will fit that second home buyer. So just because in the real world, they're trying to limit that, maybe smaller lenders are going to get more affected. We have a lot of money, and we have pools that we can put into place where we have second home money. The Hardcore Mortgage Real Estate and Business Show brought to you by Capital Mortgage Funding. The podcast brought to you by Capital Mortgage Funding, always powered, both shows, by Fairway Independent Mortgage Corporation, equal housing lender, MLS number 2289. And I'm going to tell you what, it's an exciting time to be in real estate, exciting time to be in the mortgage business, and it's an exciting time that I get to work with Becky Alley, John Kolb, Harvey Freed, for Roberto Beauchesne in the booth, director and producer of the Hardcore Mortgage Podcast and the Hardcore Mortgage Real Estate Business Show. Please join us this Saturday, Hardcore Mortgage Real Estate Business Show. Harvey Freed, the host with the most, 97.1, 9 to 10 a.m. We'll talk to you then.